Hello, I'm Angeline and welcome to Beat the Street, the show that gives you the tradable news and data you need ahead of the Wall Street Open. Now, coming up, US stocks pressured by rising treasury yields as investors wait on more earnings amid this rethink of the timing of the US rate cut. McDonald's not so loving it. First quarterly sales miss in almost 4 years due to weak demand from the Middle East, China and India. And Caterpillar climbing quarterly results. They're benefiting from US residential rebound there and also higher infrastructure spending. A very good afternoon to you. I'm Angeline and welcome to this edition of Beat the Street. Now, not long now before Wall Street starts trading, let's have a look at how equity markets are looking. I want to start off with the Dow Jones Industrials first because all US stock indices, all three major ones, might I add, notched their fourth consecutive weekly gain. That's right. It's looking pretty good there so far. The momentum, despite all those fears of momentum just tapering off. Just showing you the US 500, which is the S&P 500 as well, and showing you specifically a 10-minute chart because this way you'll be able to see what I'm talking about. But as you can see there, we're looking at a cautious open, but this comes after the S&P 500 also had a fresh record high. So pretty impressive there, these levels coming ahead of those PMIs later and also the ISMs. Just crossing over live now to New York, where Chris Vecchio is standing by for us. Chris, of course, from Tasty Live, part of IG Group. Chris, it seems like at the start of the year, the momentum was being driven, our clients say at least, by geopolitics. And now it looks like it's the Fed that's driving the music. What do you think?
The Fed seems to be in control for most asset classes. Last week on Wednesday, the dollar got stronger. We saw that stocks were down on Friday after a strong non-farm payrolls report. The dollar got stronger, bond yields are up. But there's been a little part of this whole equation that really hasn't made sense. After all, Fed rate cut odds for March dropped from near 90% at a point last week to where they currently are, sitting below 20, and stocks have moved up to all-time highs throughout this process. So for gold, for the dollar, these Fed cut odds and their shifts really do matter a lot. Stock traders have another idea on their mind right now. That said, how long can this dissonance last when gold, when the dollar, when bonds are all moving in one direction and stocks are the only people sitting out the party? They usually get on the bus at some point. So great caution today. Russell 2000 potentially losing its uptrend from the October, November, January lows here. We see that the S&P, the NASDAQ are both being pressured back towards their 1 month moving averages. This could be a very important week, even though it's a week without many, if at all, any macro catalysts that could determine significant trends here in US-based assets.
Now, the other key thing that they're watching from the party before they've, as they eye the bus, but they haven't got on yet, love that metaphor, are these earnings. And you're right, Chris, when you said last week that earnings have been robust so far, and they have been. We're still waiting on Disney, Uber, PayPal this week. We've had McDonald's already out weak, Caterpillar strong. What do you think we're going to be thinking by the end of this week?
I think it's going to be a muddled mixed picture. I loved your quip at the start of the show, not loving it for McDonald's. And a lot of these companies are facing, some idiosyncratic difficulties. Look, whatever's happening with Meta and Apple, Amazon, these big Mag 7 names, they're in a league of their own right now. The fact is that if you remove them from the picture, earnings hasn't been that great. This hasn't been a great earnings season by any stretch. And that's one of those situations that could reinforce this narrative that maybe the Fed is keeping rates too high for too long. Because look at the picture. Well, it's not all that appealing. So yes, the earnings this week, far more important than the macro calendar. There are a few things to keep an eye on, like the RBA rate decision, ISM services, maybe that German inflation report. Otherwise, it's all about those Fed speakers in the coming days. Earnings and Fed speakers, nothing else really matters as far as I'm concerned.
There you have it, earnings and Fed speakers from Chris Vecchio from Tasty Live in New York. Also, just want to remind you that the S&P 500, although it's indicating a cautious start, it is still, as I mentioned earlier on the 10-minute chart, did achieve a record high. But can that momentum continue, this momentum that we've been seeing across the markets? Well, to take a closer look, Axel Rudolph has been looking at the S&P 500 for us.
Well, Angeline, the US economy remains robust And we see the fact that basically rate cut expectations have been pushed back to May effectively of this year instead of March hasn't had a negative impact on the S&P 500, which made a new record high last week just below the psychological 5,000 mark. And as you can see here on the daily chart, basically we remain in positive territory, continue to make new record highs, and are approaching this psychological 5,000 mark. And I wouldn't be surprised, though, if we were to see some sort of consolidation around that round number, because quite often financial markets are attracted to these, but then lose upside momentum around such a round number. So we'll have to see what happens over the next few days. But basically, from a medium-term perspective, as long as we stay above last week's lows, which were made at 4,842, further upside is more likely to be seen than any downside reversal in the short term.
Thanks very much, Axel. Now, moving on to corporate news, because around 80% of the S&P 500 companies have reported so far this season, according to LSEG data, with collective profits estimated to rise 7.8% from a year earlier to a share-weighted $468 billion. What a whopper. McDonald's already out first quarter sales miss in almost 4 years, and this is due to weakness in the Middle East, China and India. Excluding one-off items, McDonald's posted a per share profit of $2.95, slightly better than thought, but it seems like investors are pouncing on the fact that it had weakness in those markets, and even the company's US side of things isn't doing, or doesn't seem to be faring very well in terms of demand. It said here that the company's US business also starting to show signs of weakness. Traffic in the US stores slumped some 13% in October, according to Placer.ai data cited by Wells Fargo. Just having a look at the chart here for you, because like McDonald's is all sessions and they are currently ticking lower there. If I show the 15-minute chart, here's the hourly chart for you as well. And McDonald's actually, so where's the salad dressing? McDonald's is not the only outfit out there in terms of a global landscape that is seeing weakness in these regions, especially China as well. We've had Starbucks coming out saying that it's struggling, but in terms of a solid response to this, they've cut their annual sales forecast, particularly because of weak sales and traffic at stores in the Middle East. Now, one of the other stocks that we are looking at for you is Caterpillar. Now, Caterpillar, a pretty strong story there coming out at the moment anyway. First quarter profit rising to $2.6 or $2.7 billion, almost $2.7 billion, $5.28 a share. Now, this was partly due to strong demand for excavators and bigger equipment, and comes at a time when the US residential market is seeing a strong rebound, and also there's higher infrastructure spending there as well. What's also promising is that the number in terms of margins for the world's biggest construction company in the energy and transportation segment, well, Caterpillar's margins rose a healthy 21% from the year prior. To other corporate news, Novo Holdings, parent of Novo Nordisk, is going to buy contract drug maker Catalent in an all-cash transaction worth $11.5 billion. This is to expand its foothold in the weight loss market, particularly through Wegovy. And the company said on Monday that Catalent, whose shares rose 12% in pre-market, is, of course, the main supplier of the fill and finish work. If you remember a piece that I did just before the end of 2023, I did highlight the fact that if you're looking for some bright sparks, some future revenues, you should look at companies that fulfill this fill and finish work, because not only do they have to complete this work for normal pharmaceuticals, but the increased demand in syringes and injection pens will mean that there's a short-term squeeze. Now, moving on to tech, I want to focus on the Magnificent Seven, starting off with some of the big ones that we've already heard from. But the Magnificent Seven, of course, are the companies that together have led the market surge really in 2023. Since their earnings, many are wondering if they're still a buy, a hold, or a sell. Well, let's start with Amazon first, shall we? They beat the street, and Amazon's shares jumped after the company beat its December quarter revenue expectations. This was on strong growth in the online spending segment during, of course, the critical holiday period. Alphabet, though, was one that disappointed. The parent company of Google was quite an interesting one because investors focused in on the cost of AI rather than the future revenues. The company said its spending on items like servers to power AI would increase this year. Microsoft was another company that had this reaction from investors. Microsoft's shares fell, even though it beat market estimates for quarterly profit and revenues. This was because the new AI features that help its customers to its Azure cloud service as well. Many investors are more focused in on the burgeoning costs rather than the future profits derived from AI. Meta also showing you that one because Meta has seen a huge amount of increase in its shares in 2023, and the company declared its first ever dividend. And as you can see from this chart, it also not too long ago surged to a record high after that news. Apple, its quarterly results were a bit more disappointing because the customers, or rather the those that watch and trade the stock, focused in on its projections in terms of growth in China. And Tesla, or rather Splendid 6 after Tesla's update, also disappointed. Just bring up those shares for you. And I'm going to widen that out so you can see the reaction. Let's try on a weekly figure. There you have it. And that's also coming after Elon Musk warned of a slower growth trajectory in 2024. So where is the salad dressing? Well, if you've had a good rally and you're a short-term investor, then you might want to take money off the table and take profits you've made already. Diversify perhaps, or maybe select and cherry pick which of the seven of the Magnificent Seven you want to continue holding. But because of the sheer size of these companies and their weighting, there is a debate that they've become akin to safe havens that may have wobbles, but ultimately they're too big to fail. For more on this, do check out IG's chief market analyst Chris Beecham's piece on Are the Magnificent Seven Losing Their Shine? You can find this on the IG website and also on Twitter at IGCom. Now, just a quick look at oil just before we go. Here's a look at US crude for you. I'm going to show you the daily chart there. Quite a lot of volatility still. However, they are slightly slipping in the current session due to that strong jobs report, very hot jobs report, which capped sharp falls last week, and also the hopes of swift rate cuts also weighing. This is despite a US promise to continue airstrikes in the Middle East, which understandably have kept tensions high. Now, before we go, a quick look at Wall Street, just as we count down to the open, and we are looking set. This is the hourly figure for you for a cautious open. But it has to be said that all three major US indices have seen four weekly gains rather. So they're coming from a very strong vantage point. And that's it for this Beat the Street. Do stay tuned and make sure you check in on at IGCom or also on our Twitter and YouTube Shorts for more analysis. We'll be back at 1:30 tomorrow for more action before the cash open on Wall Street. Otherwise, you can find me on at Angeline Ong on Twitter. This is IGTV.